Welcome to the Midweek Market Update, where I do a technical analysis and give you my thoughts on SPY, the Qs, and IWM. This week I've also got two trade ideas for us to check out towards the end of the video, so definitely stay tuned for that. First things first, let's address the elephant in the room. Huge sell-side activity hitting the marketplace today. It's very easy to get emotional in these types of situations. However, if you have a process in place to analyze and trade the market, stick to that process and you will be rewarded, be it by avoiding losses or taking smaller losses or actually getting away with some wins in tough market conditions. So in that exact light, what we're going to do is stick to our process for analyzing the S&Ps and going through today's video. So kicking it off with the sectors as we always do, who was leading, who was losing, and where was the weight? The utilities led the pack today, up 0.18%. The XLC for communications were at the bottom of the barrel, down 2.31%. As we know, utilities are a lightweight in terms of sector weighting, but they're also a defensive asset, so it makes sense that they were up there at the top of the list on a huge down day. And the XLC actually contains things like Google, Netflix is in there ironically enough, we have AT&T, Verizon, all of those stocks did take a beating today, and although it's not in the top three that we watch, it is still a heavier weighted sector, and again, it just adds up that seeing a big red number here pairs nicely with a big red day in your S&P, so nothing is jumping off the page as a huge issue in terms of our sectors. Let's get into our heavier weighted sectors though. XLK for the top of them all. The tech sector down 1.37%. XLF for financial, second heaviest weight, down 1.11%. And then your XLV for healthcare down 0.18%, largely being kept afloat by Pfizer, of course, with all of these new headlines coming out with the variant, okay? Let's check in on some of the charts though, make sure that risk isn't mounting in one place versus another. Taking a look at the XLK, things look fine, right? In terms of trend analysis, we have a low, we have a higher low, and yet again another higher low on today's session. It doesn't mean that we can't go lower, and clearly this candle structure here would indicate that there is lower to go, but from the grand scheme of things, remember that if we support at 164, that's still a beautiful thing here in the XLK. Zooming out the chart, what you'll remember, and just to give you a reminder, I suppose, let's just call that the dominant low, next higher low here. Even if we pull back into 160, we've been talking about this level for quite some time, we still have a very clear higher low on the daily, and we have a nice uptrend still remaining intact, not really posing a huge threat to the overall trend of your S&P. So on a day-by-day basis, sure, we could move into that 164, but is it threatening the uptrend? I would certainly argue no in terms of its impact on the S&P. The one concern would be that potentially maybe there's a bit of head and shoulders activity here with a neckline at the 164. Technically, you could draw it in like this. So keep that in mind, right, at least in terms of into the end of the week. But overall, hopefully you get the sense that the XLK is not a huge threat to your S&Ps right now. Next up, we have the XLF for financial sector, and these guys actually are the thorn in the side of the S&P. Remember that in the weekly watch list, from Sunday, we talked about this gap down from Friday. That was sort of the warning shot. From there, it's been kind of lower, very choppy, but definitely lower throughout the remainder or up until now in this week. So it's all about in the financials, do we catch a footing at 37.25? And if so, that would pair nicely for a super support at the daily 200 SMA. And in the grand scheme of things, again, this is the painting with broad brushstrokes, it does keep us in a daily uptrend. However, from a shorter term perspective, this is the damage, this is the drag really that's been impacting your S&Ps and causing them to move lower. Now, what's the cause for financials to move lower, you may ask? Like, what's going on here that's causing things to go awry, right? So if we take a look at the TNX while we're talking about financial things, I mean, quite clearly, your rates falling out of the sky have impacted the XLF, which have impacted the S&P. So in my estimation, TNX is definitely worth keeping an eye on. Now, why are rates moving lower? Well, Jerome Powell has certainly acknowledged that inflation is in fact not transitory. He actually mentioned wrapping up the taper sooner than expected. That way they could raise rates sooner than expected. However, think about the headlines that are floating around in the news right now. What was his reaction to the entirety of the pandemic? Monetary policy being extremely accommodating, basically easy money policies. Is the market trying to forecast that with these headlines going on? I can't say for certain, but it certainly does feel like that's kind of what's going on here with your rates, their impact on the financials, and then the causal effect on your S&Ps. So here's what you need to watch out for. These are the three scenarios that I will really be paying attention to. If the TNX continues to trend lower, meaning lower lows, lower highs, clear breakaway value to the downside, XLF will continue continue to take a beating, probably not find a footing at that 37 quarter, and your S&Ps will continue to move lower. If the TNX does start to find a floor here and move sideways, which, although we don't look at this through the lens of technical analysis, we do have some sort of support here if you want to speak broadly. If we start moving sideways, probably your XLF catches that floor at the 37 and your S&P subsides for at least a little bit. And then scenario number 3 would simply be if these start moving back higher, your XLF actually picks up, right? And then your S&P may have a bit of a dead cat bounce. So that's how your TNX will likely impact the S&P, and definitely something worth keeping an eye on. Next and lastly, in terms of sectors, we'll take a look at the XLV, and these guys are actually also slightly starting to become concerning. The main reason would be that this is a high. Oops, let's grab the other tool. That's a high. This is now a clear set of lower highs. At first, it wasn't clear whether or not we would make that turn to do the equal high thing, but as of right now, certainly starting to look more like a lower high. So what does that mean in your XLV? Well, you have something that looks like this, and you have something that looks like this. It's all about the symmetrical triangle now. Do we find support at the bottom portion, put in a higher low here, around 128, bounce, and either further consolidation, or do we break out up and over the resistance trend line? As of right now, this is really taking a back seat. The main stage is all about your XLK and your XLF, the push and pull, the relationship between rates. This is just something that's going on in the background, and in my estimation, not having too much of an impact in your S&P. So keep an eye on the symmetrical triangle, but in terms of trend, higher lows, again, not really reading into it too much in terms of what it's doing for your SPY. Let's take a look at volatility now on the VIX, okay? And we've been looking at 2-year charts all because of this. I wanted to point out what's going on here at and around the 40 mark, and we've added this in to our VIX. It's not $40, it's just 40 here in the VIX, and we're creeping up on it, to be quite frank with you. We've been spending a lot of time up and over that volatility trigger sort of level that we talk about, the 2050, right? And the next one to watch out for, continuation here, would be $40. Now, what happens at $40 historically as volatility was elevated throughout the duration of the pandemic, essentially? Generally speaking, it did mark local bottoms in your S&P, right? And it faded back off, mean reversion. So that's what I'm keeping an eye on. If it gets into 40, I'm definitely looking for bottoms in the S&P. As it sits right now, we do have a volatility event that has triggered up and over 2050, which generally means we're looking for pullback buys in the S&P. So let's go back over to the S&P and talk about this now. So there's 2 main takeaways that I want to talk about in terms of levels here. There's the long-term investing, that'll be scenario number 1, and then there's 2, short-term trading, which we'll look at levels into the end of the week. For scenario number 1 here, does it not make sense at least to start thinking about putting in a little bit of an order down here at the support trend line, being a pullback buyer in an overall bullish market? And if you're thinking about investing, right, this is like investing 101. Dollar cost averaging would say that even if you buy here and the market continues to go lower, that's okay. Maybe you dollar cost average again closer to 430 or slightly underneath 425. And in the grand scheme of things, over your course of a lifetime, then you'll eventually make it out on top, right? The market has trended that way for hundreds of years. I don't foresee it stopping anytime soon. And even just, zooming out the weekly or the daily chart here, you can see we're in a firm uptrend, right? So it makes sense, in my estimation, to start thinking about risk-friendly longs at the support trend line. It's kind of exactly what we were talking about back here, and it's just unfolding all over again. Now, scenario number 2 is for the short-term trader. That's probably you and me and anyone else watching this video who also has a trading account. So if we continue to pull back, the same exact theory applies, but you have a tight stop. You know where your risk is. If you break down underneath the support trend line, you're just out of the trade because, again, it's very likely that you come into that next level around 430. That's if the headlines continue to be severe. Let's also address the fact that I'm not abundantly confident in a directional analysis at this point in time. If I go ahead and remove all or just clean up some of these drawings, what I want to do is compare this section of the chart right here to this section of the chart right here. This is where we started to feel those pressures of big sell side activity hitting the market, and this is like it magnified, right? And what we had in here was big day down, gapped up to midpoint of the range, day down, gapped up again to the high of day up. You get the gist, right? We had a gap down, we gapped above it, we gapped underneath it, we gapped back to the open, but faded off the entire day. So directionally speaking, I'm not overly confident what the market's going to do tomorrow or the next day until all of this sort of big volatility in the headlines starts to cool off. All I know is if we come down here, I'm starting to look to be a buyer in both the long-term investment accounts and short-term trades, looking for bounces off of the support trend line with tight risk just underneath. So the levels to watch out for would firstly be this gap underneath us. That's going to be from 448.34 down to 447.57. Anything underneath that is your support trend line. And generally speaking, right, if this is going to happen tomorrow, then it's here around 443.85. If it's going to happen on Friday, maybe it's a bit higher at 444.75. You get the gist, right? You should have that on your charts. The next area would be the gap fill from here, 443.23 down to 442.61, and that's going to kind of cap it off at least into the rest of this week. I don't foresee us going lower than that. A lot of damage has been done here, and another reason why I don't see this just blindly continuing forward. Not only was it the sectors that we discussed, not only was it the volatility event, we're looking for the bottom, we have the support trend line, all of that's good. But if we come over to our internals tab, and if you're not familiar with this screen, you can get familiar in the top right hand corner. I will leave a link up there. But taking a closer look at kind of what's going on under the hood, I mean, absolutely brutal day on Tuesday's session and even getting into the end of day here on Wednesday's session. Now, what I'm getting at here with volume is that there's been huge degrees of correlation in the marketplace, and correlation does not keep a market trending. It only provides severe movements in one direction or another, and usually they're retraced, right? What keeps a market trending is quite simply rotation, right? As the sectors do this, money flows in from one, out from the other. It keeps the market trending. When there's correlation, there's nothing left to buy. If anyone's going to buy anything tomorrow, it's usually going to do something like this and push the entire market up because literally everything was down on today's session. It's a great example would be this, right? If you look at this advanced decliner, which is beneath negative 2,000, that basically means huge degrees of correlation. On the very next day, we see the exact opposite because there was nothing left to rotate into. So everyone was buying everything, and we get huge degrees of correlation to the upside. Does it last long? Absolutely not. So watch out for big correlation. What you need is more sustainable internals if the down move will be exactly that, sustained over time. So just to give you an idea of what that will look like, then we'll move along here. Basically, if your volume is respectable to the downside, we're looking at that kind of negative 300 million mark, then fine, maybe we get a trend day. If your advanced decliners kind of open at zero, trend lower throughout the day, fine, maybe you get a trend day. Maybe your advanced decliners actually open lower, but stay here. They don't actually move to that extreme of well below minus 2,000. That would also provide a respectable sort of sustainable move lower. Now, the exact same is true, but opposite for the upside case, right? I'm not going to illustrate that again, but you get the gist. We've had huge degrees of correlation, and that is not sustainable. Rotation keeps a market trending. Correlation does not. In terms of your tick down here, all you can see is just big emotion, big ticks minus 1300s, minus 1200s, sustained into the end of the day. Again, just very emotional, sort of panicking out of positions, hitting the sell button, get me out, get me out, get me out, not really waiting for some sort of lift to get out at the VWAP or something like that. So again, just a lot of emotion wrapped up in the market right now. I really don't feel like it's at this point in time something that will be sustainable over a long period. Now, could it turn into a downtrend? Absolutely. It could always turn into a downtrend at any point during the day, or excuse me, not during the day, but during the course of analyzing a chart here, but I just don't see it from the internals perspective, from the sectors perspective, from the volatility perspective. Hopefully today's insights into the S&P were useful. Let's wrap it up lastly with our sort of market profile. Again, I've got a video for you if you don't know what this is. It explains it all in depth. What I would point out about this is that we just have multiple distributions. Distribution up, number one is up here. Distribution two is this little M and L overlap. And then, some people count N, some people don't, but a little bit of overlap here as well. Simply what you're going to watch out for is what distribution do we accept into? The chunk of the day was spent in distribution one. You can see our point of control is up here. The majority of the volume is up here. So if we start moving into, number two and accept here, fine, that's slightly more bullish than bearish. If we accept into, distribution one, as we discussed right here, that's even more bullish. So I would start looking at this as 3 separate days. A critical area to just pay attention to would be here, right? At the, let's call it 45.70, just for round numbers sake. If we start trading above that, fine, we're back in the meat of this overall range right here. It's not like too much damage had been done to the market. If we resist here, look for something like this, right? Probably coming back down towards the lows in here as of the post-market right now, hovering down below in sort of section number 3, which of course is the most bearish outcome of them all. 4,500, nice round psychological number, is underneath us. So just keep that in mind as a support also. Not too much to read into other than the fact that you could start to call this a bit of a spike. It's not the most pretty thing. We get that M overlap. Traditionally, a spike only has one TPO wide. I'm sort of pushing it here. It's the same exact theory. Do we reject the spike? Do we accept inside of the spike? Do we move back into the meat of the day? It's very simple. I don't want to overcomplicate the market profile here. It's all about this level, that 45.70. Do we accept above into the meat? Do we negate the spike? Do we find acceptance in the spike here? Two-sided trade. If we fall beneath the spike, again, that's where we probably move into the daily support trend line. From there, we'll reevaluate for buy opportunities. Let's go back on over to the platform and wrap up the broad market here with our QQQ, talking about very similar patterns to what we saw in the XLK. The one thing I would point out here is that we already are technically breaking down underneath a head and shoulders neckline at the 390. So watch out for your daily 50 SMA and that 382.34. If you remember from the weekly watch this video on Sunday as well, coming in with the Fibonacci's from here all the way up to here. It's coinciding perfectly for the 50% retracement of the move. Just something to keep an eye on. Again, just like in your S&P, is probably looking for buying opportunities here, dollar cost averaging opportunities. If it breaks, looking for potential moves into about 370, noting that this is kind of a weak area of support here. It's really all about this prior set of highs you can see from this breakout point at that 369, 370, which we just discussed. To the upside, any reversals, just looking back for the top end of the range at around 400. Based on today's selling structure, the candle structure, doesn't really look like a likely scenario that we go to 400 over the course of a day. But remember that whole correlation thing. If there's big correlation to the upside, we're just going to whipsaw back and forth, right? Something like this, big sort of range in between 400 to 390. That's, QQQ in a nutshell. Next, we have IWM for Russell 2000 and our small caps taking a huge beating today. Just like in our XLF, we actually have a bearish engulfer of a candle that was already a gap down. So fairly bearish structure. Sell side volume is picking up. As we know, the I keep saying XL, but it's the IWM. As we know, IWM is generally seen as a risk on, risk off asset. And again, as we pointed out, this big fake break was already kind of a red flag. Now that we're moving back down towards the bottom end of the range, looks kind of like risk off as of right now. We'll see if we catch ourselves for support at the 215, rebound back above, or if we ultimately do have to rotate all the way to the bottom at the 208. Anything under 208, big sign of an issue here in IWM. That's kind of a must-hold level. I would definitely set some alerts around 208. The structure does suggest that we do move lower, but also keep in mind that we're starting to get a bit overextended. Wouldn't be surprised if we get a bit of a dead cat bounce, as long as it's nothing severe, and by severe I mean like huge rally back higher. I would look for bearish consolidation and then that rotation to the bottom over the course of time. Let's get into these trade ideas now. First one is on Z. Oops, let's try that again. Z. There we go. Z for Zillow Group. This is a bearish trade idea to go along with a bearish marketplace. And basically, flush point, right? If I do something like that, let's try that one more time. So cleaning up the chart while we're at it. Zooming back in, big gap down already from the earnings debacle. Everyone sort of talked about their failure as a flipping company, but you get the gist, right? Flush point is here at 53 even, give or take. Any breakdown basically takes us into relatively uncharted territories. We haven't been down here in quite some time. Let's fish for a support together. Anything underneath is probably looking for about 45.90, call it 46. So quite a ways to fall, and the reason I'm picking that is you can see back here, prior area of resistance, then turn to support. Maybe you can't see it on your screen. Let me zoom in. So here's your resistance. There we hold it as support. So what you have is a break and retest. That's why we're looking at that 45.90 as a downside target. Back over to recent times, this is just simply a daily bear flag, right? So looking for the downside here inside of Zillow. Not so interested in the trade if it takes out 56 quarter to the upside and starts working its way back higher. In that instance, this may potentially be a double bottom. So look at it however you'd like, but Zillow overall, probably not a stock that many people are excited about in the given market conditions. And then lastly, the second trade idea is going to be on CRM. And the reason, again, we only have two is because quite literally, I don't want to overload you with trade ideas that are very speculative in a whipsaw market. And as I mentioned earlier, the confidence in direction here is fairly low, right? The reason I bring up CRM is simply because we're way extended, right? And potentially we get a little bit of a dead cat bounce off the daily 200 SMA, this prior level that once again is a break and retest that held here. So 252, if we can start trading back above it, look for a bit of a retracement, maybe to the midpoint of the range here around 261. Also this prior gap area, right? Resistance from in here. Last thing I'll do before I send you on your way, I know today's video is fairly long, is taking out the fibs from the top all the way down to the low to see where that 38.2 is. And just a thing of beauty, you literally cannot make this stuff up. It's coinciding perfectly with that area of resistance which we mapped out around that 261, I believe it was. Yes. So those are the two trade ideas. Obviously, you're not going to get interested in this trade if it just continues to break down. down, you'll avoid it. I wouldn't try to short it here. That would be chasing in my book and likely lead to some pain if there is some sort of whipsaw action back to the upside. So that's truly going to wrap up the video. If you enjoyed it or learned anything new today, let me know in the comments section or by giving the video a thumbs up. Don't forget our secondary channel is linked in the description, and all of that being said, I wish you a green trading week.